Good evening. Welcome to the special forum tonight on banking union in Europe, prospects and challenges. My name is Xiang Jingwei. I'm a professor at the Columbia Business School. This event is jointly organized by the Economics Department's Program on Economic Research and the Business School's Jerome Chazen Institute of International Business. As all of you know, the European Union has agreed to start a banking union sometime soon. The details have yet to be worked out. But there's agreement about a single supervisory mechanisms and single resolution authorities and role of ECB in supervising banks. Many more important questions are still to be determined. So what are the issues still need to be worked out? And what is the likely shape of the new banking union in Europe? And how would financial markets and monetary policies respond to that? And how would those developments affect financial sector in the US and the rest of the world? For insight on these important questions, we will turn to our two very prominent speakers, former policymakers from Europe. Vítor Gaspar is the former finance minister of Portugal, having served from 2011 to 2013. He was previously Director General for the ECB and head of a Bureau of Economic Policy Advisors at the European Commission. He's currently with the Bank of Portugal. Athanasios Orphanides is a professor of the practice of global economics and management at the MIT Sloan School. He served as governor of the Central Bank of Cyprus from May 2007 to May 2012. As governor, he oversaw the introduction of the euro into his country and subsequently served as a member of the Governing Council of the ECB from 2008 to 2012. Prior to his appointment as governor, he served as senior advisor at Federal Reserve Board. The panel will be moderated by our own Professor Ricardo Reis. So I will turn to Professor Reis from now, please.
Great, thank you very much, Xiang. So we're going to try to do this as close as we can to a debate. And so what I agreed was that each one of the speakers, first Vítor, then Athanasios, will speak for about 6 or 7 minutes with an introduction, and then I'll ask a few questions, and then I'll open it to the floor for questions that you may have. So start with Vítor, please.
Thanks, Ricardo. The way I like to tell this story comes very naturally to me because I can start when I became finance minister in June 2011. One of the things that marked the beginning of my tenure as finance minister was the informal meeting of ministers of finance in Poland during the Polish presidency. You may recall that particular meeting of the ECOFIN and the Eurogroup was attended by Timothy Geithner. Timothy Geithner, Secretary of the Treasury, was invited to come to speak about global developments and how the crisis in the euro area was impacting the US and the global economy. The view that was widely publicized at the time was that in the view of the US Treasury, the crisis of the euro area was the single most important factor of risk to developments in the global economy. And if you look at the international press, you see that the international press was dominated between, say, June 2011 until July 2012. It was dominated by headlines about the possible fragmentation of the euro area, and that was a catastrophic risk that was not only dominating events in Europe, was also the most important development in the global economy. Now, the things have improved quite substantially after the summer of 2012, and the reasons are basically of three kinds. First of all, the countries that were mostly under stress adjusted and made remarkable adjustment efforts that if you do look at those countries as an average, you see that the countries have been able to regain competitiveness, eliminate current account deficits, in general increase exports quite substantially, and eliminate the need to finance themselves with the rest of the world. So national adjustment has been progressing fast. National adjustment does reflect, first and foremost, the political will of national governments to do what is necessary to maintain full participation in the euro area and determination to achieve successful adjustment in the euro area. That's the first dimension. The second dimension is political will at the level of the heads of state and government of the euro area and of the European Union to preserve the euro area and the European Union as a political project. That is very clear from what was done in June 2012, and there is a very influential blueprint that calls for banking union, fiscal union, economic union, and political union. Of this, the most operational dimension and the one that has more immediate impact on the current crisis is banking union. And I've been arguing consistently that we need to broaden the concept of a banking union to have a fully robust financial union that can withstand shocks like the crisis that we're facing. And the third element is the euro area needed a selection mechanism that would exclude the possibility of self-fulfilling bad equilibria taking hold, and that was precisely what was achieved with the announcement by the President of the European Central Bank, Mario Draghi, in July 2012, with the whatever it takes within our mandate speech in London, and then the announcement of the outright monetary transactions program of the ECB in September. So at this point in time, we are in a situation where banking union is well on track to be operational. Market sentiment has improved quite substantially, and Europe and the euro area are definitely not mentioned in the list of relevant risks for the global economy. And with this short introduction, you can see that I'm the optimist in this debate, so I have to turn now to the pessimist, which is my partner in this debate, Athanasios Orphanides.
Thanks, Vítor, for this wonderful setting up of the debate. And also, Ricardo, thanks for actually bringing us here. I think being in this room and having Italy all around us is very appropriate, since Italy is one of the most important links that are going to determine over the next 10 or more years whether the euro construction, the way we know it, will manage to survive or not. And first, let me speak a couple of minutes by first agreeing with Vítor on the great improvement in perception that we have experienced in the last year and a half since July of 2012. And where we are right now in terms of market perceptions, you know, we're in New York City, so we have to be sensitive and aware of what people around us believe about the future of the euro area. I agree that the situation appears to be much more stable right now, and clearly markets globally show incredible complacency with regard to the risks emanating from the euro area. I think we need to give a lot of credit to central banks for this. I'd like to start with that. First, a lot of credit to the ECB for removing the tension with the announcement of the OMT in July of 2012, as Mario Draghi's remark that the ECB would do whatever it takes within its mandate in order to stabilize the situation, and then the September of 2012 actual decision. That's one element. The other element, you may wonder why are markets doing even better in the last few months. I think we need to thank, all of us Europeans, we need to thank the Federal Reserve for the tensions it created in emerging markets since last summer. Those tensions are wonderful for us because they have taken the spotlight of the euro area. And investors globally now say, hey, you know, where we had half a dozen euro area member states that looked like terrible cases of emerging markets, they are not really as terrible in the spectrum of emerging markets as we thought before. They're a little bit better than the typical emerging market economy, and this has helped a lot reverse some of the flows and further stabilize the situation. But let me then turn into what my assessment of the situation right now is and what my concerns are about Europe. I think we can all agree that the construction of the euro as it was put together in the Maastricht Treaty and implemented starting in 1999 was a mistake. At that time, I was in the United States, and I know very well that the consensus among US-based economists was that it would be a mistake to proceed with this experiment because there were too many gaps, too many questions, and it was unclear how these gaps would be answered, how these questions would be addressed if something wrong that happened. As a European, at the time, I shared the view of the optimists in Europe that suggested that the European project, as we know it, it started really 60 years ago almost now. This is not just since the creation of the euro. It has been evolving, and it has been making tremendous progress in building a unified Europe step by step. And it was always an incomplete project, and the whole notion and the whole optimism was based that in the past, in this almost 60-year period, every time there was a crisis, a challenge to the European governments that were part of the project would work together, cooperatively, find a solution, move forward, deepen the European Union idea, and improve Europe in that regard. So it was assumed or hope, you can pick whichever one you want, that if anything went wrong with the construction of the euro, the same process would take over, and there would be a cooperative solution that would further deepen the euro area. And what we have experienced in the last 4 years, from slightly different angles, but both of us have experienced this, is that this hope or assumption was really incorrect. What we have seen in my interpretation since the beginning of the euro area crisis is a situation of great animosity in Europe. It really started going downhill from late 2008 to 2009, when then governments in some member states decided that it was not really appropriate to try to find a solution to the emerging problems that would be good for Europe as a whole, that it would be a better approach to have each member state of the euro area tackle the difficulties that were emerging on their own. And this really led to tensions and some examples, and unfortunately I have seen examples where governments were actively trying to push the losses from the crisis. Whenever there is a crisis, we have losses onto the citizens of other member states in the euro area. And this is what really worries me about the European project. I'm now watching this evolve from the United States. The United States had a similar crisis in 2008, 2009. And during the first 2 years of the global crisis we've seen, the response in the US and Europe was the same. The critical difference was that in the United States, we had a single federal government, but a single central bank, single Congress. They're all in Washington. You may disagree with the decisions they've taken, but they've taken decisions trying to minimize the damage for the country as a whole. If I contrast that with what I've seen in Europe we have had a number of governments in the euro area where we really have the problem with the common currencies tying us together in a very counterproductive way. We have 17, 18 governments fighting it out against each other with nobody in the room having the objective to adopt solutions for Europe that would be minimizing the cost for the euro area as a whole. So that's the setup I want to give you with, because I do worry that we are not headed in the right direction. I would agree with Vítor on another point. June 2012 was a critical moment in the crisis. The euro area member states met. There was a European Council meeting. This is the meeting of the heads of states and governments in Europe. I believe it was in Brussels, that particular meeting. Yeah. And this is where they agreed in principle to form a banking union, which is the grand topic we have today. That was one of the critical elements for reducing the tensions. The tensions up to that point had been identified as a so-called doom loop that essentially kills a state and the banks of the state because they are interdependent to each other. The idea, and this is what the leaders in Europe said, was that a banking union, if properly created, would have eliminated these links between the banks and the sovereigns and helped Europe advance. Unfortunately, I do not agree with Vítor's assessment that we are moving in the right direction in this process. The governments really, in my reading of the decisions have been taken since June 2012, have been moving backwards, and we had in December of last year a very, very negative decision for Europe, which essentially was to ask the ECB to continue with the preparation to take over as the supervisor of banks in Europe. This is one element, one of the important elements for the banking union, without at the same time agreeing on a euro area-wide deposit guarantee and resolution authority, which are the two most important elements for the euro area. Unfortunately, that was a very negative decision, because up to December, there was some hope that the European governments would have been able to move forward in this regard. And as of December, we know that the banking union, as was envisioned in the summer of 2012, is dead. And let me stop here.
Very good. So let me start then with one question for you. So Athanasios expressed this common view in Europe that it is during crisis that, in a sense, Europe moves forward, that it's in the response to the crisis that the integration deepens. At the same time, you are pessimistic about, at the same time, we are going through a crisis right now, and it does seem that the next step is exactly the banking union. So to what extent do you think that you agree with this idea, first Vítor and then Athanasios, that it is the crisis that leads to reforms, and why are you optimistic that Europe will take the right step this time to solve the crisis and move forward, or are you pessimistic that the step right now is not going to be taken, unlike the history of Europe over the last decades?
Okay. First of all, I must say that I was one of the negotiators of the Maastricht Treaty. So I think that the monetary union, as designed in the treaty which was signed in the early 90s, was a concept which is appropriate for Europe at that particular point in time. I fully agree with Athanasios that it was not a complete project, but then again, in democracies and open societies, projects are never completed. All our societies are work in progress. The second aspect that I very much want to emphasize is that Europe tends, as Athanasios, as a matter of fact, emphasized, to progress from crisis to crisis. And in terms of my professional career, I have seen basically 3 cycles of crisis in Europe. In the 1980s, in the early 1980s, there was a socialist government in France that pursued expansionary budgetary policies after the election of François Mitterrand as president of France. In that context, the French franc was under pressure inside the exchange rate mechanism of the European monetary system. There was a turning of policies in France in the direction of what they called competitive disinflation, désinflation compétitive in French. And in that context, immediately after this turnaround of policies in France, there was a French-German consensus on the way forward for Europe, and that led to a big impulse in European integration that led to the single market program and eventually to the launching of the process of monetary unification. Now, in the 90s again, and I was at that point in time already active in European matters, there was a very important crisis in the exchange rate mechanism of the European monetary system in 1992-1993. In August 1993, the French franc was under tremendous pressure. It was at that point the general view that no way under this turmoil one could advance towards a monetary unification. But again, there was a possibility to generate a French-German consensus, and monetary union took off as forecasted, as agreed politically on the 1st of June, on the 1st of January 1999. Now, at this point in time, the ingredients that I saw in the first 2 examples I gave you are in place. That is, quite a substantive progress was achieved in Europe. The political will to go forward is very strong. There have been some tensions involving the conduct of policies in France. There has been a turnaround in the policy orientation in France. And my understanding is that the French and the German government are very active finding a consensual path forward, which is exactly the way things work in Europe. We have a common track and then a consensus involving France and Germany makes it operational and therefore defines the path following. That's what I would expect to see happening in the very near future. And that's why I'm optimistic, replying positively to the question you posed, Ricardo.
So let me try to describe why I do not quite share that view and what's different about the euro. That was not there before the creation of the euro regarding coming together and resolving cooperatively a problem like the problems that Vítor described materialized before. The euro is different in a couple of respects, but one of them is the following. By tying together the financial and, most importantly, the banking component of the financial systems in the euro area with a single currency, very important tools that member state governments had in order to manage their domestic economy disappear. This increases the leverage of whichever governments happen to be perceived as strong during a crisis. And this was the first crisis we have had with this element. When you increase the leverage of the government that is perceived to be strong in a setup like this, you risk creating non-cooperative behavior where some governments may actually use the construction of the euro in a way that may create tremendous losses for other countries. Let me give you an example of that. I agree with Vítor on the importance of France and Germany agreeing in principle on a common line for anything to be achieved in the euro area, simply because together they are almost 2/3 of the euro area. So in one of the most important blunders during this crisis, we had this walk on the beach in Deauville in October of 2010 between the President of France and the Chancellor of Germany. And that was a pivotal moment in the crisis when those two governments decided that it would be a good idea to inject credit risk in euro area governments. And it's true, they agreed on the same line. They did not, however, take into account that by injecting credit risk in euro area governments, this was the so-called PSI concept, the private sector involvement. The idea was that if any government faced liquidity problems in the euro area, the other euro area member states would first require a haircut on the debt and then decide whether there would be a loan made to the country, completely turning upside down the traditional IMF framework on this. So I had that decision that a few weeks later caused the collapse of Ireland. And of course, the consequences of that decision on Ireland were completely ignored, and that's the kind interpretation for taking that decision. And if we did not have the euro as a construction, the Irish government would have been in a much better position to defend the interests of their own country. If they were faced with such an unfortunate decision taken by the French and German government. This is just one of the examples of what is different now than it was before. Tying the banking industry actually increases the leverage of those countries that happen to be perceived strong. Doesn't matter which one is in any period. It was a particular set of countries in this particular crisis. It could have been a different set of countries. It's just that the decision-making framework is one that was setting us up for a crisis like that in the euro area. And at the end of the day, we ended up not having governments that would show a sufficiently strong spirit of cooperation or really respect for the European ideals to find a better solution.
May I make two remarks?
Yeah, interject, absolutely.
Two remarks on two very specific points. But before doing that, I should say that Athanasios is one of my favorite economists, and I always learned a lot from Athanasios. So it's slightly embarrassing for me to be in this confrontational mode, but those are the rules.
It's by design. This is what
It's my fault. You can blame me.
It's the rules of the game.
Vito and I go back a long time, so it's, what are you doing to us?
But anyway, you did say something, Athanasios, that I believe is not correct, which is the following. You claimed that the asymmetry that we see between creditor and debtor countries in the current crisis is something which is new in the context of the euro area. That's actually not true, I believe. The fundamental point about the asymmetry between creditor and debtor countries is a point that was done by Keynes in the very first book he published on the Indian currency and finance in 1907, and he was emphasizing the asymmetry between creditor and debtor countries at the time of the negotiations of Bretton Woods. And I believe I saw a wonderful quote by Keynes in a paper by Guillermo Calvo recently, and that's, by the way, the reason I found these two quotes from Keynes. And the asymmetry between creditor and debtor countries is present in all the examples I gave. Now, in the early 80s, the French were very much complaining about the asymmetry in the adjustment mechanism inside the European monetary system, and they were, in a sense, complaining politically about the predominance of the Bundesbank in the context of monetary arrangements in Europe. The argument was again repeated in the early 90s. So this asymmetry was really a part of the process. And in Europe, we have this element of confrontation, but then a cooperative collective action is agreed and implemented. That's what happened in the 80s. That's what happened in the 90s. That has been happening in the context of this crisis. A lot has been achieved at national and European level, and the process is going to continue to be successful. Now, I had 2 points to make. This was the first point, and the second I forgot.
But let me interject and that would give you a chance to remember the second point, that I agree with you that there is always the asymmetry that you describe between the stronger and weaker. I'm going to call them stronger and weaker countries in this. And I agree with that. But what I said is that the construction of the euro created a mechanism that leverages the exploitation potential by the stronger countries on the weaker countries. Take the example I just mentioned. When you mentioned before, 20 years ago, we had 22 years ago, now we had the ERM crisis. Mm-hmm. The weaker countries at that point in time could actually entertain the idea of devaluing their currency. That was very important mechanism for stabilization that was available to them. That was costly to the stronger countries, and that reduced the leverage that the stronger countries had in coming up with a better solution. This was not available during this crisis, and as a result, the possibility for exploiting the imbalances was much greater. And in addition, we have the other element that the common monetary policy with the ECB in the middle is binding us together in a very counterproductive manner for these elements. And let me, since this is about the banking union, make a point to link it back to the banking union. Why were we concerned about Spain 2 years ago? Why was Spain experiencing tremendous deposit outflows for a long time? Well, simply because anybody who would have been concerned in Spain about the ability of the Spanish government to provide temporary assistance in euro to a Spanish bank could simply go open a bank account anywhere else in the euro area at a very minimal cost and secure his position. That was there because of the common currency, and this is something that was good if it was not exploited, that we had the common currency working everywhere, we had freedom of capital everywhere, but it was bad if it were exploited. For example, already in 2012, we knew that it was a good idea to set up a banking union, meaning having common supervision, a common deposit guarantee. Let me not go to the resolution, because if we were to offer a common deposit guarantee to all depositors in all member states of the euro area, then the Spanish depositors would not need to worry about the link and the strength of their government, and we would not be having the deposit flight out of the country. So we knew these things, and the question is, how come that the governments did not actually agree to set up the banking union 2 years ago or 3 years ago? Why is it the case that some governments continue to object to setting up a meaningful common deposit guarantee in the euro area? Well, there are many explanations, but one explanation is that the construction of the euro is such that as long as you do not create that common deposit guarantee, you can create and maintain a competitive advantage for the banking industry in your member state. And this goes back to what I mentioned before, the uncooperative behavior of trying to see how much can we grab and keep in our member state and how much we can take away from the others. What is going on in Europe the last few years, I can describe in a different way by comparing it to the United States. The United States does have a model banking union where the Federal Reserve is essentially the supervisor. This is the role that the ECB will be taking at the end of the year. And the FDIC is the agency that provides the deposit guarantee and also the resolution authority in all states in the country. You do not have the situation in the United States where if, say, California is in terrible fiscal mess, perhaps they have to start issuing script. Who knows? Perhaps nobody trusts the state government. It's not the case that there will be questions about the safety of deposits in California and the cost of funding for a business operating in California. This is because we have a true banking union. By contrast, in the euro area, we knew that we could have had a similar setup, but we still cannot create one. If we created something like that, then the Spanish depositors 2 years ago would have been safer. Small businesses would have been able to borrow money at the same rates that small businesses of equal creditworthiness are able to borrow money in the stronger countries. We would have been out of this crisis. But think about the political dynamics that cannot let that happen. Can the governments in the stronger states, who happen to be in the stronger position right now, afford politically to give up a tremendous competitive advantage that some of the interests in their member states have right now and give that away to the member states that have citizens who are European citizens, but who as voters have nothing to do with their elections? It's a tough nut to crack.
Well, I'll let you interject, but let me steer in a certain direction.
Okay.
So Athanasios has said how he believes that the current banking union is ultimately incomplete because it misses deposit insurance and resolution authority, and also that even in the small decisions that there is too much of a non-cooperative behavior. But you at the start had talked that not only we should walk towards banking union, but even financial union, which seemed more ambitious. Mm-hmm. So to what extent do you think that we should be more ambitious? To your extent, therefore, do Athanasios' concerns make you worry about that, and that, if anything, the banking union would even be more incomplete? And why are you optimistic that we'll reach there, given those?
Before I tackle your question, which is indeed a central question, I want to make two very brief remarks. I remember my second remark, which is about the fact that in the context of the exchange rate mechanism of the European monetary system, the doctrine, which was broadly consensual, is that by fixing the exchange rate, the central banks of most participants in the mechanism would gain credibility for price stability by basically mimicking the policy, the monetary policy of the very credible Bundesbank. Now, this doctrine was accepted in most countries, it was politically very relevant, and so it was very costly politically for a national government to propose a sharp devaluation of the currency, and typically the reason why we had such a turmoil and such a turbulence in exchange markets was precisely because, given this political cost, governments would postpone and postpone and postpone the decision to realign. One of the best statements that does show that, in fact, the functioning of the exchange rate mechanism was very close to monetary union is the perspective of the Dutch Central Bank. At that point in time, the governor was Wim Duisenberg, who became the first president of the European Central Bank. And Wim Duisenberg said, indeed, we are fully autonomous in our interest rate decisions. We can postpone an interest rate move by 30 minutes or thereabouts. So the autonomy that Athanasios is talking about is mostly an illusion if one is playing the game by these rules. And those were the rules that were accepted by all members, or almost all members, of the exchange rate mechanism. The second aspect is that sometimes when we look at progress, we're very impatient. One of the things that I've been looking at is at the process of the construction of the US banking system and US financial system. So I started with the actions by Alexander Hamilton in the late 18th century. Now, the Federal Deposit Insurance Corporation was created, if I'm not mistaken, in 1933. So it took about 140 years from the start of the process to a situation where the system resembles what Athanasios is describing now. There were many crises in the United States during those 140 years, and there were even instances of financial fragmentation, very much like what we have seen in Europe. So it was hard work in the United States as well, right? In our case, I think that we are progressing definitely much faster than the historical United States. Now, coming to the banking and financial union and the process of building it, I believe that Athanasios and I agree that the banking union must have three fundamental elements. The first one is the single supervisory mechanism. That's the responsibility for banking supervision, which is now in the hands of the European Central Bank. That's basically something which has been politically achieved. It is being implemented very fast in Frankfurt. The single supervisory mechanism is being built. Then there is bank resolution. Bank resolution is work in progress. There is a legal document on banking resolution which is now consensual. There is a very important gap, which is work in progress, that has to do with the European backstop to that resolution mechanism. The third element is, as Athanasios also said, we must have a European deposit insurance scheme, and again, we need to have a European backstop to ensure that there is not the connection that Athanasios was talking about between country risk and banking risk. We need to separate the two. If not, we don't have a robust, integrated financial system. Now, the point that I add to all of this is that in history, at least as far as my reading goes, a banking system does not operate in a vacuum. It must be complemented by financial markets. And those financial markets have to be fully integrated so that the system, the financial system in the euro area is a robust system that has multiple channels, multiple interlinkages that can operate in a robust way under stress. And we need that robustness because what we have seen in this crisis is that the financial mechanism not only did not help absorbing the crisis, but as a matter of fact, they amplified the crisis. We had financial fragmentation during the crisis, and we must make sure that that will not happen when the next one comes. And we will have some next crisis, and therefore we cannot have a narrow scheme of financial integration. We need to have a multiple channel based integration network, and so we need banking union and a broader financial union that basically means the integration of financial markets.
Let me also, although you're certainly happy to retort to exactly what Vítor said, but let me also raise the issue of, you've talked a lot about the asymmetry of power across countries. The crisis certainly was stronger hitting in some of the very small countries in Europe, such as Greece, Ireland, Portugal, and Cyprus. Do you think that if the next crisis were to hit Italy, and since you brought up Italy together, would we have seen the same dynamics, or would things look very different in terms of the ability to cooperate, given that it is such a much larger country there?
And I'm going to start answering that and waiting for Vítor's rebuttal by reminding you of the earlier point I made about leverage that a government has to protect its economy, its banking industry, its businesses, relative to the governments of the other countries. Size matters for that reason. So the fact that some of the relatively smaller member states have been hit, whereas other member states appear to be just barely making it, is endogenous to this. Let me remind you that we do have a player in this game. It's a very interesting game, quite unique in the history of monetary affairs globally. We have a player in this game who can always innovate tools and within its mandate will do whatever it takes to salvage the situation when we have a crisis. Let me remind you, for example, that when we came, not in 2012, in 2011, we had the big scare before the summer of 2012 was in October, November of 2011, after the heads of states of Europe on October 27 decided to impose something that ended up being an 80% haircut on Greek debt. And while they kept insisting, and this is what the communique said, Greece is unique, trust us, just trust us, everybody else will honor their debt, they created major problems immediately for a number of other member states, including the third largest member states in the euro area, Italy. And Italy was on the verge of following the Irish experience. Well, this other player in the game at that time, the ECB, decided that it could do something about it, and that was the time that you had a couple of decisions within a few months. You have that one. That one was in after October. You have what became known later on as the wall of money. Just give as much liquidity to any bank that wishes to have that liquidity. Just bring us collateral. You decide whether the collateral is going to be Italian debt or something else. You decide, completely up to you. But as much liquidity as you wish. Just come to us, cheap money, for 3 years, we'll do it. And this is the sort of policy innovation that you would not have seen if a member state that is worth only 2% of euro area GDP, I think Portugal and Greece were about 2% of euro area GDP, or smaller would get from this other player in the room. So it's quite endogenous to the game we're observing.
I want to open it to the audience. So if people would like to ask a question and get the discussion going, we have a microphone in the middle there. If you do speak, please just say your name and just your affiliation, just so that people can interject. Padma.
I'm Padma Desai. I'm the Harriman Professor at Columbia University in the Economics Department. I have a question and a comment. The question relates to Mario Draghi's announcement in July 2012, whatever it takes, and let go on a very liberal monetary policy amid cash in the European Eurozone area. Were there some tensions with the German Chancellor and with the Central Bank of Germany, the person in charge there? Because the German leadership and policymakers always worry about inflation, given the German experience. So that was my question. Are there any tensions between the ECB leadership and the German Central Bank leadership? The second comment relates to, I think I often notice, especially European policymakers, contrasting and comparing the experience of the Eurozone with that of the United States, saying how the United States has a single currency, a single Federal Reserve, and all that, and yet it had tensions for 140 years of policy making and so on. I think a better comparison would be with a country such as India, with 15 major languages, with a vast cultural difference between the north and the south of India. And after 67 years of independence, it has held together with a single currency, a single Federal Reserve, a central government. The country is having an election in May. I speak as an American because I have lived here for 50 years. So my sensibilities are more American, but that, I think, is a better example to draw from of how a country with so much diversity, linguistic, cultural, policymaking, because Indian states have enormous freedom to invite foreign investment, to make their own budgets and so on. It has held together, but I sometimes feel maybe European and American policymakers don't want to draw from the example of an emerging market economy. Thank you.
So I was going to keep the same order, unless you.
So on India, I cannot really comment because I'm profoundly ignorant about the specificities of the Indian financial system and implementation of monetary policy in Europe. But I was very intrigued by your comment, and so I will try to find out. I happened to, I was with the governor of the Central Bank of India some 3 months ago, and if I had benefited from your comment before, I would have asked him. Probably we will meet again, and I will try to make sure that I learn from the experience of India that indeed looks like a very diverse territorial unity, and so from that viewpoint resembles closer the degree of diversity that we have in Europe relative to the United States. But something that is very important to emphasize is that the degree of autonomy across the member states of the European Union is considerably bigger, more profound than what you see across the states of the United States. The United States is a federation, and the European Union is not a federation, is something that we would characterize as a confederation, not indeed a federation. Now, when you think about monetary policy and inflation, clearly in the debate about monetary policy in Germany, there are comments about possible risks of inflation that are much less frequency elsewhere in Europe, and concerns about too low interest rates and the penalty that constitutes for pension funds, for example, which is also a relatively rare comment. Part of it has, of course, to do with what you said, the memory of hyperinflation in Germany, but in some instances, the concerns about policy matters in Germany seem to be weakly correlated with concerns elsewhere in Europe. That is, the European Commission conducts regularly a survey called the Eurobarometer. And if you go around Europe and see what is the most important problem from the viewpoint of the Portuguese, the Spanish, the French, and many others, the top problem is unemployment. But in Germany is excessive debt. They're concerned about the excessive accumulation of public debt. And when I saw that, I was really surprised. But it does illustrate the type of differences that you always have when you have integration on a continental basis.
So I was also intrigued by the comment, and I was going to answer it by pointing out to what Vítor said. If you think about it, the way many Europeans would think about the United States is that it's the country that was built after the Portuguese and the Irish and the Germans and the Greeks and the English came, and somehow it seems to be working better. How come? It's the same people. Of course, there are more people, and there is this element of envy. So this is one element. But the other element that's important is that we study each other's history very much, so we can be making these comparisons as we go by. And we do not, unfortunately, this is a gap in our education. We do not study in as great in detail the history of really all of Asia. We just don't. It's a gap in our education that blinds us to that comment.
Yes.
With regard to the OMT, and you mentioned how the Chancellor might have seen that policy. First of all, I would say that the announcement of the OMT, Mario Draghi's statement, and then the decision in September, should not be interpreted as moving ECB monetary policy to become more accommodative. And if anything, since then, monetary policy in the Eurosystem has become considerably tighter relative, say, to the monetary policy of the Federal Reserve. One very easy metric. It's not a perfect metric, but it's an easy metric that can be used for this comparison is to check the size of the balance sheet. Since that was made, we had in September and then December of 2012, the Federal Reserve speeding up the printing of easy money, if you want to describe it like that. Whereas if you check the balance sheet of the Eurosystem, it has been declining, allowing that particular metric of monetary conditions to tighten, despite the fact that the euro area was in a severe recession and inflation was not really projected to be at the target. So it wasn't a deliberate decision to be on the tight side, which is, in terms of assessing the risks. So it wasn't easy monetary policy. What was it? And why would anybody object? What the ECB did with that decision was essentially attract the attention of market participants that it would be dangerous to their health to bet against the euro. It was just an implicit threat. And when you have implicit threats like that, the question is whether they are credible or not, and if they are credible, for how long they are credible. And it happened to be very effective in that threat was considered by a sufficiently large number of markets participants, credible enough for long enough to stabilize the system. Basically, didn't have to do anything. It just created doubts about whether it was a good idea to going against the euro. We don't even know if it would have worked if challenged, and we still don't know. You don't know these things until something is tested, and you have to take your bets as to whether you would like something like this to be tested after things stabilized or not.
Mark? Do you mind going to the microphone? Because otherwise the acoustics is a little peculiar. Do you mind going to the microphone? Yeah. Okay. No. So why don't we then do two questions in a row? You, Danielle, and then Mark.
Okay. So I'm Daniel. I'm a student in the economics department, and my question is related to Professor Desai's point about tensions and to what Mr. Gaspar just said about the Eurobarometer polls. So you both talked about the previous ERM crises as giving us potentially some insight about how this banking union negotiation might go. But I was just thinking that it seems to me that something that might be quite different this time is the degree of public animosity and anger in the relevant countries. We've seen huge protests, lots of public anger against austerity in the weaker countries. In the stronger countries, a sense of anger as well, feeling like they have to bail out the poor countries. I would just want to know how you think this might complicate the negotiations this time around, if that could change the game.
So Mark.
Hi, Mark Kingdon, University trustee. Just wanted to ask the two gentlemen if you could speculate on whether we'll ever see a national banking union with a full FDIC, which we all think would be a good idea, and if so, when might this occur?
Good question. Very precise.
Okay. Daniel, I'm much more optimistic. I have a very much more benign reading of the political situation in Europe in the following sense. Although the debate has been very lively, and indeed we have witnessed protests on austerity programs throughout Europe, in general, the national political systems have been able to withstand this very intense political debate while standing to a very large degree unchanged. That is, look at my own country, Portugal. There has been an intense debate, but the constellation of political forces that we have in Portugal in 2014 is very much what we had in 2011. The players are the same. The positions have evolved because reality has evolved, but the way the political debate in the country is structured is broadly unchanged. And if you go around Europe, that is basically the case in the vast majority of countries. You do have one or two odd exceptions to this rule. Now, in the context of the next European elections, it is likely that my remark will prove compatible with some radicalization of the representative elected to the European Parliament, but that's just an example of political polarization under a crisis, and I don't see that as being qualitatively different from what we have seen previously in Europe. That is, the reason why the political situation in the early 80s and the early 90s does not look dramatic to us now is simply because we know that the story ended well. But the process was quite messy. In particular, in the 80s, people in Europe were very pessimistic about national politics, and they were even more pessimistic about European politics. At that point in time, European politics were characterized as Eurosclerotic, and that was a reasonably consensual qualification that was made about European politics. We simply forget. We don't care much about what happened in the 80s. Now, the question about banking union and national banking union is very, very interesting, in particular because in the question, the euro area is being qualified as a nation. Now, I don't think that we are going to have the euro area or the European Union as a nation during my lifetime. I'm a very firm believer in the fundamental political principle of the primacy of the national dimension of politics, and I believe that will stay. But I do believe that this primacy of the national dimension of politics is compatible with the building of a banking union in the euro area and deep banking and financial integration in the European Union in line with the single market. I believe that in that context, we will have a European resolution mechanism backed by a European backstop facility, and we'll have a European deposit insurance scheme backed by a European backstop as well. And I believe that will happen relatively fast. So
it's interesting. We can be looking at the same Eurobarometer results and draw different conclusions. I am quite concerned about precisely the animosity that is being observed in Europe. There are a number of questions on trust in the Eurobarometer that one could see over the past, their evolution of the past several years. There is a question on whether European citizens tend to trust the European Union as a whole or not, whether they tend to trust the ECB or not, whether they tend to trust the European Commission or not. And the deterioration in the level of trust of European citizens in most member states, actually strong, weak in most member states, is incredible. The trust in the ECB, for example, is as low as ever right now, despite the fact that, when I look at European institutions and the way they have handled the crisis, in my mind, the ECB is the only institution that tried to work in a more or less European way, putting politics as much as it could, which is not perfect, on the side. The European Commission completely politicized by contrast. That lack of trust actually is one of the reasons why I am so concerned about the prospects for the European Union as a whole. We have had a crisis that has been mishandled, and I fear that it has worsened the prospects for the European project overall, not just the euro area. projecting on the behavior of governments we have seen in the last 5 years, I am not optimistic that we will have a true banking union in the euro area ever, really. The dynamics are such that the governments who happen to be in the stronger position try to play with the legal text so that they can always have the upper hand for many, many, many years down the road. And we have seen in the last couple of years, unfortunately, the negotiations confirm this point. So, frankly, I put no chances in creating in the euro area a concept equivalent to the FDIC-Fed combination, which would be, a bank may be facing some difficulties in Arizona. I'm not going to have the political parties in Connecticut fight it out and influence whether the depositors in Arizona are going to be receiving help from the FDIC or not. This is unthinkable in the context of the United States. This is being hardwired in the negotiations that are taking place right now so that we can still have this wonderful talk that our European leaders are giving us. I challenge you to go and download from the web some of the statements out of European Council meetings. In virtually every single one since the beginning of the crisis, the leaders of Europe resolved to do whatever it takes to protect the European project that is so incredibly important for the welfare and for peace in Europe. And they keep repeating that thing, and then we see the decisions they take. So with the current configuration of governments, I really don't have much hope we're going to see good solutions coming up. And then you say, how can you change the current configuration of governments? You would need fundamental political reform, and there I am with Vítor. It's virtually unthinkable to get a political reform that would help us to a good outcome right now.
Just to be clear, Athanasios, let me ask just for one very brief clarification. You think that by January 1, 2015, the negotiations for the banking union will collapse, or just that they will approve, but there will be banking union in name, but with no effective bite?
It's the latter. The banking union. So some people, even
So we'll have a banking union,
Vítor
just not-
almost suggested it. Say, we already have agreed to have banking union. Of course, it's a banking union that doesn't have the FDIC component, so it's only in name.
Last round of questions. So again, we'll collect 2 questions.
Miguel Marin, PhD student in economics. And my question is, we have European elections coming up. Will that affect what you have been discussing so far about the banking union?
Hello, my name is Marie, and I'm a student at the School of International Public Affairs. My question is regarding the symmetries between the stronger and the weaker countries. And like stated earlier, the weaker countries have made great efforts to balance their budget by decreasing their deficit, while strong countries like Germany continue to run surpluses. And do you see any future policy, or how important do you think it is for the stronger countries to also follow the weaker ones in achieving a more balanced economy?
Very good. Massimo, did you want to ask something? Rich, can you help Massimo get to the microphone?
So I would like to make a comment related to the concept of union. So you mentioned once, I think, the word fiscal union as well at the very beginning, and I see the two things a bit connected because by the way, I'm Massimo Morelli. I'm a professor of economics and political science here. I forgot to say that. So they are connected in the sense that in your disagreements, I see that, or I hear that, that there are 2 aspects that are separate. One is that with the union, or banking union or fiscal union, you want to perhaps be able to handle a shock better than, or a crisis better than Europe has been able to do before. And that part is where the disagreement seems to come from, because there is some pessimism about the fact that the stronger are willing to concede more in terms of transfers or commitment to transfers or contingent transfers and so on to fix the next shock. And so that seems to be where the disagreement is. Whereas the other aspect that I don't think has been covered enough is that a union has a value in uniformity of reaction to, for example, behavior. It's almost like a cultural value, where a banking union and a fiscal union would have the possibility to have uniform expectation, to create uniform expectations in terms of what will happen if I do this, what will happen if I'm a firm and I'm doing and I'm sort of trying to work in the wiggle room, you know, and not really not sure what the regulation is going to be, because the Italian or the Greek banks are being lenient, and the German one that I have to interact with because I'm doing international business is not as lenient. So all this, it's not surprising to me that the first agreements would be in terms of supervision and resolution, because those things, supervision and resolution, belong to the second category of creating uniformity, which is very important in its own right, even if the pessimist view on the possibility of doing also transfers as a you know compensation and sort of, you know, doing what the federal government in the US would do is impossible. So I just wonder whether you would agree with this kind of dichotomy where things you agree, things you disagree.
Very good. This is the last round. Please, 2-3 minutes at most to each one.
I'll do my best. So, Miguel, on the issue of the European elections and banking union, what's going on in Europe in 2014 goes much beyond European elections. That is, the fact that we have parliamentary elections means that there will be a new commission. There will be a new president of the European Commission. There will be a new vice president of the European Commission in charge of economic and financial affairs. And then towards the end of the year, we're going to have a new president of the European Council, because the mandate is 2.5 years. And likely the way the Eurogroup operates will change in that context as well. So what we have now in 2014 is an opportunity to have a change in the political cycle in Europe. That includes the European Parliament elections, but goes much beyond European Parliament elections. And that's why the consensus between Germany and France, which is being built, can be leveraged, because the European political cycle is such that it can incorporate that political impulse relatively quickly. Now, in terms of the characteristics of the adjustment process in Europe, it is true that countries that were in deficit have adjusted quite sharply. Current account deficits, public deficits have fallen quite substantially. It is true that Germany had and has a current account surplus and a general government surplus. Clearly, the need for adjustment in creditor countries is recognized as a matter of principle, and as an example, the German Finance Minister Wolfgang Schäuble has been on record stating that increases in wages in Germany are part of that process of adjustment, and so clearly the need for action by both surplus and deficit countries is recognized. What we do see, however, is that, as is usually the case, the adjustment in deficit countries was much sharper, and as a matter of fact, I believe that every single country that was under stress has been able to generate the surplus by now. There is, I believe, not one single exception. Massimo, very quickly on fiscal union. I was asked a question in a panel in a conference organized by the International Monetary Fund in September, and the question was, what are the minimal requirements of a fiscal union necessary for a well-functioning euro area? And basically what I said is that we need to have the fiscal elements which are necessary for a financial union to be effective. Now, that's a very minimal fiscal union in the following sense. Since the bank resolution scheme and the deposit insurance scheme are fed by contributions from the financial system itself, and that's the way the system has been designed, one does not need transfers of any kind. What one needs in a worst-case scenario is bridge financing. And the public finance implications from bridge financing are relatively limited, and so I'm reasonably confident that a solution for that relatively minor problem can be solved at the political level relatively quickly.
Yes, so my take briefly on the European Parliament elections. No, I see no chance of influencing any of the current discussions going on with regard to the banking union. I should mention one concern. This might be a test. We're going to see this in May. Is that we have in a large number of the member states of the European Union the rise of anti-European parties. And we're going to see in May just how significant that rise is, because if that rise ends up being significant, it may actually compromise progress in Europe in a number of things in a major way for the reasons that Vítor mentioned. So we do not know that. This is the first time ever where this is a concern, which is again telling us about how the European people are thinking about the progress in Europe. With regard to adjustment, more symmetric adjustment, frankly, you can never force someone to consume more if they want to save more. We've never managed to do that, so we always have this asymmetry in the adjustment, and I think we will always continue to have the asymmetry in this adjustment. The issue is whether we have automatic mechanisms that make the adjustment smoother and less painful. This is what could be done if we had a fiscal union, to bring it back to that question. Going forward, we could think of many elements in a fiscal union. Think about just a partial common funding of unemployment insurance benefits. Is that a fiscal union? Does that involve transfers? Or is it simply the broadening up of an insurance mechanism? Oh, when we think about insurance, is that a transfer mechanism? Or is that really a mechanism that, yes, it does transfer resources from some individuals to other individuals in a contingency if something goes bad? So it depends really on how you look at things. I think that we can improve the insurance aspects of what governments do without going in the direction of engineering permanent transfers from one member state to another member state. That is something that I do not foresee at all, and frankly, I would not agree with and design like that. I don't think it would be good for Europe in that direction. I'm going to end by saying that I agree with Vítor that we don't really need to deepen the fiscal union to stabilize a big part of the problem. If we complete the banking union, we're going to do a lot better going forward. Mm-hmm. When I'm thinking about the FDIC, I view the FDIC as just an insurance device. I do not see the FDIC as part of the fiscal mechanism of the United States at all. And this is how we would like to design the deposit guarantee and resolution facility in Europe as well. It should be industry funded. As a matter of fact, I think that you may not even need to have a backstop from the states, because if you think about it, the ability to tax future deposits everywhere in Europe or everywhere in the euro area, and the monopoly to that taxation is enough to give you a good credit rating and the ability to borrow if you do not have the resources that you may need in order to help out resolving a bank or bank deposit guarantee somewhere. So I don't view that as a fiscal operation, and I think that it's a very important way to go. Some of those who oppose going in that direction even suggest that the creation of this insurance scheme is a fiscal operation, and then oppose to it because they do not wish to advance anything that would deepen fiscally the European Union.
Terrific. Let me thank everyone for coming, and especially thank our speakers, Vítor Gaspar and Athanasios Orphanides. Thank you very much.
Thank you, guys.
This is terrific.